Well, good morning from here in London, and welcome to today's FS Club seminar, A Fresh Approach to Risk Management. And we're delighted to have with us today Chris Burt and Peter Neville Lewis from the Risk Coalition. Quite interesting, both of them are also dialing in from London, and Peter is my neighbor, so I can look down on his house, but unfortunately we haven't seen each other in over a year. So Peter, hello, how are you doing? You'll know me, I'm Michael Mainelli. I'm one of the directors of Zien, and it really is my pleasure to be able to introduce so many of these FS Club webinars. And we can only do so because of the, as I say, the tolerance of our sponsors who allow us to range widely and freely across technology, economics, and finance. Today's topic, risk, has been a running issue, as we all know, for the last 3 decades or so, as increasingly we've taken a risk-based approach in financial services, and often unseen, a very strong risk-based approach in many operational businesses outside of financial services. So we hope to have a good discussion about that today. Now, my job is to get out of the way as quickly as possible and let you hear from our experts, and I'll be delighted to do so, but just a couple of reminders. Firstly, please do use the question and answer facility in the GoToWebinar. You'll send questions in to me and I will feed them into a conversation with Chris and Peter after their presentation. All of the questions and comments that you make will be sent to them. Your email is attached to it. So if you want to contact them directly, just type a question or comment in and I will make sure that they get it. The slides have been posted and you can see them on the website, as well as a link to Raising the Bar, a booklet which came out in December of 2019 by Chris and Peter, for which I provided a foreword because I thought it was a very good booklet and well worth reading. And finally, the presentation itself will be up in a couple of days for you to share with friends and colleagues. So with no more ado, if I may, folks, the floor is yours.
Thank you, Michael. Could you move to the next slide? Right, and okay, so today's presentation is on a fresh approach to risk management. So we thought we'd start with some old chestnuts, really. So if we go to the next slide, please, Michael. We thought we'd start with 3 lines of defence. Now, as some of you may well know, a little while ago, the IIA, the Institute of Internal Auditors, decided to revamp its view of 3 lines of defence. The 3 lines of defence has been around for a while. Became very fashionable after the financial crisis in the 2008, 2009. It was a response from the regulators and organisations trying to improve accountability for risk management. But it has had critics. It's been seen as difficult to implement. It's been seen as slightly ineffective, doesn't really achieve what it sets out to achieve. And so the IIA decided to revisit 3 lines of defence, and we'll move on to what they've come up with very shortly, but I think there are a few things to point out from 3 lines of defence. The basic premise behind it probably remains sound. So if you step back and think about the 3 lines of defence and what it's trying to achieve, it's trying to ensure that there is independent oversight and challenge of management decision making, because obviously in the run-up to the global financial crisis, there was unconstrained management decision making to a large extent, and that ended up in all kinds of difficulties. So it's an extension of the 4 I's principle. That's the basic model. Next slide, please, Michael. So 3 lines of defence is dead, and then unfortunately it's not dead. The IA brought it back. They just dropped of defence, and it's now the 3 lines model. So in the IIA's 3 lines model, they've largely left the first and third lines untouched. And they've tried to fiddle with what they see as the role of the second line. Now, unfortunately, I don't think they've done a particularly great job with this. So if you look at the diagram below, you'll see that first line reports to senior management, absolutely clear. Third line internal audit reports through to the governing body, typically through the audit committee, that's fine. Second line, if we focus on second line risk management function, just for simplicity, the IIA has them reporting through to senior management. Kind of understandable. If the CRO sits on the executive exco, then yes, they are part of management, but also the CRO should have a direct report through to the governing body, through to the chair of the board risk committee. And in fact, that is a requirement of European regulation, and we're still subject, or we're still aligned with European regulation. So the model as defined below doesn't fit with European regulation. And secondly, the IAA doesn't actually own this model. It's so the Basel Committee is currently revising principles for sound management of operational risk, and they lean heavily on the 3 lines of defense model, still call it the 3 lines of defense. So I'm not quite sure what the IAA was hoping to achieve with this. Next slide, please, Michael.
Well, that's great. We're looking here at a poll. Would you ditch the 3 lines model in your organization if you could? So absolutely, it's the devil's work. Probably, it just creates confusion without any benefit. Probably not. Not perfect, but has its uses, and definitely not. It keeps management on their toes and encourages robust challenge. So I'm just launching the poll now. Fingers on buzzers. The FS Club audience is normally extremely swift, and today is no exception. We're already up to half of the audience has voted in 8 seconds. I think that's a new record. Just going to leave the poll open a few more seconds longer as we get up to 75% of the audience has voted. And I'll be closing the poll in just a second. Let's have a quick look at the results. And basically, 60% is probably not, another 19% definitely not, so that's 80% would not ditch it, they would keep it. So that's back to you then, Chris.
Okay, I think Peter's going to pick up from this point. So Peter, do you want to come in here?
Yes, certainly. Just a quick sort of review, really, of what the 3 lines model basically is doing. I think most people will be familiar with this, with the first, the second, and the third lines. It's set out on the slide. The point is, what actually is the real function and remit of these 3 lines? Are they trying to achieve separate things, with the third line providing overall assurance, or should each of the 3 lines be providing some form of assurance, so that you get a more holistic view? And we have very loosely termed this integrated assurance, because first of all, there is this issue around 3 lines. If Internal Audit, Institute of Internal Audit have removed defence but not replaced it with anything else, that leaves a slight question mark, I think, in a lot of people's minds. So I can well understand why people don't want to throw the baby out with the bathwater. But I think the model itself does need some advancement, particularly when we look at the complexity of modern risks, often referred to as non-financial risks. I think that in itself is a bit of a misnomer, because of course there is severe balance sheet impact from issues arising from climate change, from culture, from reputation, all the things that ESG is looking to address as well. And I suppose the big question is it possible for one part of the risk management function within an organization, which obviously includes internal audit, is it possible for them to provide the board with complete assurance, or does it need to be coming from a multiplicity of sources? And our view is very much that that looking forward, over the next 5 to 10 years, this is the direction of travel that organizations should be embarking on. And it's interesting that very recently the CSFI, who are a very well established, well thought of leadership tank in the city, came up with their annual banana skins report. And at the top of the list there, you've got macroeconomics in second place. The quality of risk management is still high in 6th place. Reputation is in the top 10. Culture comes in at 12. You've got sustainability, very much part of the whole ESG picture, at 10, and political risk at 13. So there are a lot of these risks out there, which I don't think one particular line, particularly if it gets siloized, as it not always, but very often can do in organizations is seeking to provide the board with that assurance around risk certainty that it's looking for. But we do think that really critically the focus needs to be much more on the first line. And this is clear from a number of documents that have been written, including Basel and the European Standards Board, etc., banking standards. And even Michael himself, when he wrote the foreword, said the emphasis on first line responsibility and accountability for risk management is overdue. I think so. Can we move on to the next slide, please, Michael?
Indeed. Just a quick question from you, Purser, Peter, for the sake of clarification, is there a minimum size of organization to which the 3 lines apply?
That's always the whole issue of where do you draw the line? Clearly, there's a huge difference between fintechs and much larger organizations. But I think the principles nevertheless apply, that everybody who is involved with actually managing and executing the business, ensuring that the control functions, particularly within FS, are properly maintained, and that all of that is being done, the risk governance around that is being effectively looked after and reported on. There needs to be a holistic framework, but it's going to be a journey. And for smaller companies, clearly there isn't they don't have the financial facility and maturity to build a 3 lines model from scratch. But if the direction of travel that everybody should be aligned to the strategic objectives of the organization and looking to achieve those, but also being aware of the risks that get in the way, and what residual risk we're prepared to accept in a risk-taking business, then yes, I think you can apply this to almost any organization. It's largely common sense.
Great.
So we're looking at here a slide on just fleshing out integrated assurance, and these are things which the Institute of Internal Audit themselves have highlighted. Alignment. What do we mean by alignment? I think what I've been saying, that we need to have the lines and the functions all headed in one direction. And again, quoting Michael from his foreword, we're looking for one holistic view, and that word holistic has come up time and time again. This is what the board requires: is assurance from multiple sources that their objectives are likely to be achieved. Collaboration is something that the IIA have emphasized very, very strongly. I was talking to somebody yesterday who used to occupy a senior role in a large FTSE 100 in this area, and she was talking about the fungibility of lines, which I quite like. I hadn't heard that term before, but it does mean that there needs to be much more flexibility around cooperation and information sharing and discussion, etc., between the existing 3 lines. Accountability. Well, that has to shift, and we'll look at another slide in just a minute, more, I think, from the risk, the oversight and control function that lines 2 and 3 have tended to be saddled with and seen as, to the front line. But that, of course, means that the first line does need to have the right training, the right education, the right understanding, awareness of strategic objectives, etc., if it's to do the level of reporting which is required to make this new assurance model that we're proposing function the way it needs to. And finally, objectives. We've spoken about them on a few times already. That, of course, is the whole point of a board, to set the strategy and to involve itself in risk-taking, which is managed in such a way that you can achieve your strategic objectives sustainably. So here's the next slide. This is a slightly exaggerated diagram, but as you'll see between the left and the right models, we have shifted the first and third lines around because we feel that at the moment there is too much focus on the third line as being the ultimate source of assurance. Of course, it does have an independent status of its own, but to make the point, we do feel that the allocation of resources and responsibility and of course accountability needs to shift significantly more towards the first line, and that's a journey for a lot of companies. And as I said before, it's not going to happen overnight, and it will also be wrong, I think, of senior management and both the second and third line to complain if the first line is not delivering what they think they should be, if they're not provided with the correct resources, the right education, to enable them to do risk analysis and reporting to the standards required, which can eventually go through to the board. Next slide, please, Michael. And very briefly, just Gabby, some of you will be wondering what on earth is Gabby. Gabby is an online tool which accompanied our document Raising the Bar, and which enables organizations to assess themselves against the principles and guidelines that we put out. GABI stands for Gap Analysis and Benchmarking Insights. Now, we've been collecting data for some 6 months or so. It has been slower coming in than we had hoped, but that is entirely due to current circumstances. However, from the data that we've got so far, and we will be releasing some validated data probably early part of Q2, what we've seen here is, as in the 2 red boxes, very much reinforce what I've just been saying, that embedding first-line risk-related decision-making is something that a lot of companies and respondents have said they need to do better. There are a series of questions which we've asked people against the principles when we've asked them to score the principles, but we've also said, where do we need to improve? And we've made some suggestions. And this data here is coming from those auxiliary questions, things that we need to be thinking about spending more time on doing better. So it's interesting that the 2 of the very top ones address first and second line responsibilities, division of responsibilities and accountability, particularly in the first line. If we look at the 5th one across, the orange one, spending more time on emerging risks is something else which could well do with a lot more focus. And these are issues which have not just come up out of the blue from this survey. Before we released the report in December 2019, we did some 60 interviews with senior risk professionals and internal audit, etc., and some board risk committee chairs. And the feedback we got from that and the short questionnaire we attached to it indicated similar trends and lines of thought as we're beginning to see from some of the data and feedback from Gabby. So that's enough for me. I'm going to hand back to Chris now, and I think we might have a poll coming up even.
We do indeed have a poll coming up, and you and Chris wanted to ask our audience, is the traditional approach to risk appetite helpful in running your business? Absolutely, it's a thing of beauty. To some extent, it has its merits. Not really, it gets mentioned, but doesn't really impact decision making. Or finally, definitely not. It's totally meaningless in the real world. And I'm just launching that poll now. And again, fingers on buzzers from our audience who are about to beat their past record. Yes, 53% in 8 seconds. Well done, everyone. We have some good and strong opinions out there. I'm going to leave the poll open just a few seconds longer. Well over 3/4 have voted. And I'll just close the poll now and show you the results. And basically, it depends. It's the audience seems to indicate, to some extent, for 70% of the audience, to some extent, the traditional approach to risk appetite is helpful.
Right. So we're all really heavily bought into risk appetite then, clearly, which is good. It's excellent, because I'm going to talk to you about abandoning risk appetite as an approach to risk. So that's jolly good. I'm pleased about that. My slides have disappeared, Michael. Are they?
Just a split second there, just coming back.
That's right. There we go. Right. So we said we talked to you about a fresh approach to risk management. We thought we'd explore 3 lines of defense, because that forms part of the approach. And what we were hearing there is people are broadly okay with the 3 lines of defense. 80% of the people would not bin it, but clearly it needs to work better. The Gabby results say that it needs to be implemented better. That's fine. So the answer to that, I would suggest, is probably some kind of an integrated assurance model, which I won't go into now in any depth. But I will go into a different approach to risk management, which is been around for about 25 years. So it's not actually new in any way, but it's been around for about 25 years. But for whatever reason, I think probably because it never received significant regulatory backing when it was first launched, it's not really got huge traction, but it is starting to get a lot of interest now. So certainty management, or objective-centric and certainty management approach to risk management. What is this? Well, it's focusing on the organization's top objectives and doing what's needed to achieve those objectives. Now, you would say that that's normal risk management, which it is, but there is a subtle difference. So if we just step through the process, then we can open up to a discussion and questions about how this might work. So an organization needs to define its top-level objectives. Now, most organizations will define a bunch of strategic objectives, strategic aims. We want to expand into this country, this region. We want to improve profitability. We want to do whatever it is. And that all comes under that strategic aims category there at the top. What a lot of organizations fail to do is they fail to identify those objectives, which they're obliged to do as part of their license to operate. So continued viability, ESG, compliance, culture and conduct. So there's a broad range of categories of strategic objectives that organizations should set for the senior team to achieve. And if you don't do that, then your risk management is going to go in the wrong direction to start with. So by setting a broad set of strategic objectives across a variety of categories, you ensure that your risk management efforts are focused on the right kinds of things. Okay, next slide, Michael.
Just before we move on, Chris, Andrew Blackmore would just like you to expand a little bit on how does this apply to what you meant in the poll question by a traditional risk appetite. And John Spain makes a point here as well. It may sound like terminology, but it is a good point. He says boards should not be seeking certainty. It is simply unattainable. And so the use of certainty as opposed to perhaps probability, I think, is an interesting point. Just might want to comment on those before we move on to the fresh approach.
Okay, so in terms of risk appetite, the difficulty with traditional risk appetite is that it typically starts with a statement from the board, which is, you've probably all seen them. They're slightly esoteric. You try to understand what exactly the 2 or 3 paragraphs of text mean. Really quite challenging. Some organizations focus in on financial metrics because that's easier to get your head around. But then you get to the qualitative side and trying to set a risk appetite using qualitative statements around how much conduct risk you're going to take. That's probably a bad one because most people won't want very much that at all. But those types of things is very, very difficult. So trying to understand what traditional risk appetite actually means in practice is difficult, and translating that into measures and metrics and some kind of risk appetite framework, it's not easy. And then trying to embed that into management decision making, the whole thing, it's been invented by consultants. Let's be honest with you, it's been invented by consultants to keep consultants busy, and most organizations struggle with it. So that's my general view of risk appetite frameworks and how they work. And in terms of certainty, we'll come on to that, but basically you're absolutely right. So a board cannot have certainty. So this approach to risk management says, define your strategic objectives at the top level. The board then needs to prioritize those top level objectives in terms of their criticality to the organization. Those objectives that are more critical require a greater degree of certainty. There is no absolute in any of this, but a higher degree of certainty than those that are less critical. You then assess the certainty of each of your objectives by looking at the risks that attach to the objectives and looking at, for example, there may be some positive activity, some good things that you're trying to make happen to achieve the objective as well. So essentially, for each objective, you look at the bad things that could knock it off track and the good things that you're doing to help achieve it. And then you make an assessment of the certainty of achieving that top level objective. If you are not sufficiently certain that you're going to achieve a critical objective, you need to do more. You are implicitly above your risk appetite. You need to do more. You need to mitigate risks further. You need to do or make more good things happen. The other thing is risk lists. Most organizations will produce lists of risks, and that will go to the board risk committee or the audit committee, and they'll look at them and nod and say, jolly good, move on. Completely meaningless. Risks need to be presented in the context of the objectives to which they relate, so that your non-executive members, who are, let's be honest, part-time, come in for a couple of days a month at the most, come in for tea and biscuits primarily, they they need to have information presented for them in a way that means that they can actually see very quickly what this means. So if I can see a strategic objective, I can see the risks attaching to it, and I can see that we're hot on these risks, and that my certainty of achieving this objective is lower than I would like, then there's an interesting conversation to be had with the senior management team. Next slide, please, Michael. And this is where we touched on integrated assurance, but this is the kind of reporting. This is a very simplified example. So this is the kind of reporting that you would like to see. So you'll see there, certainty assessment, first line, green, amber, red, whatever it is, against those objectives. But also what you would hope to see is that you would hope to see the second line expressing a view in terms of how certain they think achieving those objectives are based on their understanding of the risks facing the organization and also the good things that the organization is trying to achieve. And if you screw them to the floor and push them really hard, you might even get the third line to come up with an opinion on certainty of achievement of objectives. So this is not about who is right and who is wrong, but what this is trying to do is it's trying to present the board with a range of views, and what you're looking for is the differences in opinion. So for example, on this little chart, we've got ESG social, green all the way through. You probably wouldn't spend any time on that whatsoever. And we've got culture and conduct, very high, but red all the way through. So we would push management in terms of what the heck are you doing here? We need to do more. We need to make this more certain. But the one that probably the board risk committee or the board would focus on is compliance, very high. We have a mix of opinion there. We have red and amber. Okay, so it's not looking good. Or we'd pick on ESG governance, and we have, again, a difference of opinion. Why do we have that difference of opinion? So what this does is it brings different perspectives, puts them in front of the board risk committee, in front of the audit committee or the board, and enables those discussions and opens up the conversation and the debate. And this is really where the integrated assurance comes in, because as we showed earlier, the first line becomes the primary source of non-independent assurance to the board because they've got complete coverage of the business. The second line provides risk assurance, and the third line provides independent assurance. But necessarily, internal audit is quite a small function, and it'll be quite focused and zoomed in or lasered in on certain parts of the business. So first line, primary source of non-independent assurance, second line risk assurance, third line independent assurance. You put the whole lot together in a pretty picture, and that tells you where you're going as an organization. And interestingly, this is forward-looking. It is not historical financial information, scores and doors, where have we been? This is where we're going. So this is exactly the kind of information that most boards would want. And you'll see not a single reference to risk appetite. Next slide, please, Michael. So major advantages, there's no need to talk or to create those really horrible woolly risk appetite statements at the board level, which basically no one can understand anyway. Risks and key performance indicators for projects and stuff are attached to sub-objectives further into the organization. So you can actually start at the very lowest part of the organization. You can start at process level. You can have process level objectives and cascade them upwards, if that's a thing. And the achievability of objectives at the lower level will have an implication for the achievability of objectives at the higher level. And so you actually get a consolidation and a roll-up of risk information. And that produces that chart that you just saw. And the other thing that we shouldn't underplay is it creates strategic alignment throughout the organization. So risk management suddenly goes from being this business prevention box-ticking exercise to actually being a key determinant of performance and driving the business forward and keeping it strategically aligned and focused on what the organization is trying to achieve. And I think that's our last slide.
It is indeed, and we move to some of the discussion points. There are quite a few points. Please, folks, do enter into the GoToWebinar question bar any questions, comments, or observations. But I've got a few. Well, first, you probably saw my eyebrows go up when you mentioned that the non-executive directors were there only for the tea and biscuits. Mark Duff says, non-executive directors, we are used as a source of expertise in our subject matter. Cliff Moyse is curious what type of biscuits. And I'm curious because over the last year, what biscuits? But anyway, um, but I think Mark has a very good point here, which is when it comes to this, we have this tension, don't we, that why boards want a non-executive director isn't quite aligned with what various regulators are proposing, i.e., that you are a full director whether you like it or not. There's no distinction between the two. Any comments on that?
I'm being facetious when I say they just turn up for tea and biscuits. Clearly, I see independent non-executive directors as almost like hired guns. These are gunslingers. These guys know their stuff. They come in, they work for 3-4 different businesses. They carry information they've learned from these different organizations. They come in and they shoot management. I'm being, again, facetious slightly, but they ask really good, focused questions to get to the nub of the issue. And that's the value of them. They are, they sit on the board. They're there for a period of time, but they genuinely don't spend all their time within the business. So they can't possibly know everything that executive management does, which is why information needs to be presented in a way that it can be quickly absorbed and then framed into a really good laser-guided question to land on the CEO's nose. So that's what a good INED is able to do. They're hugely valuable, and I was just being slightly cheeky just to get a response.
Ian Shackle says, much of your proposed approach is music to my ears. As a risk management and compliance leader over the last many years, I always promoted business partnership between those functions and the rest of the business whilst maintaining independence of mind and reporting line. Do you, Chris and Peter, think that there need to be modifications to the extent and nature of independence of those providing assurance? And I might just add to that on a personal note. You noted the inversion you're seeking between the first and the third, so that the first is there. How much of this has been consultancy driven out to make money for the boys and girls in the various audit practices and consultancies out there?
Okay, well, I'll start with that. And Peter, do you want to join in a second? So if I start, I think it's historical. So before we had 3 lines of defense, we had management and we had internal audit. And internal audit was there to test controls and to provide opinion on controls, and management didn't test controls because that was internal audit's job. And so what we've seen over a period of time with the creation of the second line and with the movement of internal audit to become more of a provider of assurance and not management's control testing team, we're having to create that inversion. And it comes back to what is the role of the first line. The first line, and I'll say again, is the primary source of non-independent assurance to the board because they have complete coverage of the business. Now, if the first line owns the organization's risks, they are responsible for managing those risks, they presumably should be capable of reporting to the board on those risks, although a lot of organizations look at the second line for that, which is probably not right. So the question I always ask of a senior management team is, can you demonstrate that you're under control? And if they look a bit wobbled at that point and they start talking about internal audit and risk management, then I know that they haven't got the right infrastructure in place. It's their business, they're running. They need to be able to demonstrate that they're under control, which means they need to be able to evidence in some clever way that the control framework is in place and working. So that's the point I think I would make. Peter, I'll let you speak. I'll let you bring it.
Well, all I would really add is I'm going to quote something which is actually in the IAA document, one of the principles about creating and protecting value. And I think that, and yes, consultants have a vested interest in working with organizations to improve their functionality and viability and profitability, et cetera. But I think this little statement does get to the nub of what this is really about. All roles working together, collectively contributing to the creation and protection of value when they're aligned with each other and with the prioritized interest of stakeholders. And this alignment is achieved through communication, cooperation, and collaboration. Now, what we've seen in the feedback that we've been collecting from the Gabi surveys, and that's well over 100 now responses that we've had, is clearly indicating that there are some issues, even considerable issues, around the trust. And Chris was saying, how do you know you're in control? How many organizations really understand what their first line activities are doing, and are they reporting accurately and concisely and analytically what is going on? And I think this might well require, and I think everybody has vested interests, and I think sometimes, you know, an external pair of eyes could be very helpful. It doesn't have to be an expensive exercise, and funnily enough, actually running a Gabi survey on your own risk governance will probably give you, because it comes up with, it virtually spits out the thematic analytics for you at the end. It tells you where you need to improve, and who is saying where, what, which parts of the business are saying we need to be doing better at such and such and such. So there will always be a role for consultants.
Jeremy Wilson says here that the first line needs maturity, experience, stature, and trust at board level within any enterprise entrusted directly or indirectly with other people's savings. So here a financial services emphasis. All employees across the entire enterprise need to understand and buy into that. And that suggests an overriding cultural imperative. To establish and sustain that culture, it must be reflected in recruitment, people development, and performance management across the enterprise. I don't see that human component reflected in your or the three line of defense approach.
I think it's an interesting point. I didn't call out risk culture. We call it risk culture. I know that other people disagree that exists or not, and just call it culture. I don't mind. We didn't call it out because that wasn't really the primary argument we were trying to make. But absolutely right. So you have hard controls. Bank reconciliation is a hard control. You got lots of hard controls, and you have soft controls, and risk culture is a soft control. Soft controls will undermine the effectiveness of hard controls every single day of the week. If you don't have your soft controls right, if you don't have your risk culture right, then it doesn't matter what controls, hard controls you've got in place, they're completely useless. So it starts with incentivization at the top, and you work through from there to make sure that the organization, that people are bought into doing the right things and are not incentivized to do the wrong things. It's easier said than done, because also, how do you influence culture? Anthropologists say that you can't really influence culture. It's the sum of its parts, and that cultures only really change as a result of shock. So you'll have a shared narrative, and it's only when that shared narrative is proven to be false that you move on and come up with a new narrative, and that's when you get cultural change. And so in order to drive cultural change within an organization, you need to create a shock. You have to say, well, the old shared narrative is wrong. Let's break that somehow. Okay, we can now have a period of time when we can move to a new shared narrative, a new culture, and that's the point at which you can make significant change in culture. But that's hard to engineer. Peter, you're an expert on this stuff.
Well, I would just say that with the Principle 7 for board risk committees goes into this in some detail, risk culture and remuneration. Of the 50 sub-principles, so guidelines within that part of the document, 7 of them address risk culture and remuneration, whether the organization's purpose, values, and board-approved risk culture is appropriately embedded in the organization's risk strategy, reflected in observed behaviors and decisions. And we then list 7 points. So I think we certainly have not overlooked it, and also in the section which deals with the CRO and risk function, again we reference risk culture. So it is there. But it is, as on one of Chris's slides, it's a component part of strategic objectives. And we know that the FCA and the PRA are focusing very clearly and strongly on that at the moment. I mean, I have to say, I can remember talking to Hector Sanz in 2010, and the FCA was around about this. And here we are 11 years later, and we're still waiting for the regulators to come up with some definitive culture audit assessment. But the initiative is on the way now, and will arrive later this year for sure. So
well, few more questions to get through, so we'll have to speed up a little bit here. Syed Hussein is curious, why do banks and insurance companies continue to use risk appetite statements and risk appetite monitoring reports if they don't add value? Most organizations use risk and control self-assessments by the first line to demonstrate assurance, but they're very much backward looking. Can you recommend an alternative? And Sophie Hutchinson, I think, points to an interesting bit, the conflict between the first and the second line. The 3 lines of defense model has given 2 lines of defense departments plenty of opportunity to say, I am oversight and validation, but it's not my job to X, which irritates senior management and first line tremendously. Coupled with the growth in numbers of both first and second line of defense teams, how is your new approach going to lead to a more efficient and less people heavy, i.e. less costly understanding of risk and how to manage it?
All right. Okay. So let's start with the RCSA thing. Yeah, absolutely right. Most risk and control self-assessments, most organizations do it. We should ask the question around that. I suspect it's the devil's work, or highly unlikely to be a thing of beauty. RCSAs are generally backwards looking, absolutely right. Most organizations don't do them very often, sometimes just once a year, and it's a bureaucratic nightmare. So the answer is, how does management demonstrate that it is under control? Well, this is where we talk about integrated assurance, and I have worked with clients to introduce positive assurance reporting, where actually senior management defines its key controls, but then actually spends most of its time and effort focusing on those monitoring controls that give it comfort that the key controls are working. So, for example, a bank reconciliation is a monitoring control. If a bank reconciliation works, everything underneath it in the cash cycle worked. And so the sensible thing is to, yes, understand what your key controls are, and you might need to do some boring RCSA process once a year, but on an ongoing basis, you have your monitoring controls, which give you a flavor for whether your key controls are working. That's a far smaller set of controls to keep an eye on to monitor. But the caveat is monitoring controls are detective, and in some circumstances, you need to be having effective preventative controls in place. So it's not a panacea. There is always going to be an element of painful, bureaucratic, burdensome work. Technology can help, continuous control, monitoring, all that kind of stuff that's been around for decades and still hasn't quite broken through yet, but maybe it will do with AI and all the rest of it.
Yeah, Hugh Purser made a very similar point. Can automation such as AI help carry more of the burden? I'd like to turn to we've got time for just 2 more, I'm afraid. I'd like to wrap up. Jane G points out that she was told by somebody at a Big 4 consultancy categorically that banks do not care about reducing financial crime, and you haven't mentioned this. And Ian Harris opened early on with a comment that, is there a natural conflict between risk management models of this kind and the organization's ability to manage and avoid risks arising from unethical or out-and-out wrongful behavior by rogue actors? We've seen all of these independent folks very carefully writing out any responsibility for finding fraud or crime in anything that they do. So where does it fall here?
Well, I think
in terms of go ahead.
It's another culture issue, isn't it? At the end of the day, it's people and behavior, and culture, after all, is just how groups of people behave. SMCR was a first step in trying to pin accountability onto senior people in financial services. It's being extended, and coming down the track, as I hinted earlier, is going to be a much wider oversight of people behavior, conduct, coming from the FCA, and it will be mandated and it will be reinforced and regularly supervised. That is going to happen. Can you get rid of rotten apples? No. They're always going to be there in every organization. But I think there are some organizations which seem to harbor them, and I think public opinion actually will slowly, and is not even slowly, it's quite quickly beginning to, to seek out this type of behavior and condemn it. It's an ongoing journey, isn't it? It's human nature. And it closely linked to remuneration.
Well, I'm getting a number of thanks through from a number of people. So it's always a warning to me that we're coming to the end of time. Anna Hinder makes a fun comment that my parents will be in shock that I'm actually using my anthropology degree and points out that cultures change in many different ways. But I think I'll conclude on the last bit, which is cost. I too, when I see these sorts of models, take a deep breath and sigh. Here we go again. And Bob McDowell says time's an expensive commodity, but what maximum percentage of operating costs should be indicative of the resources deployed before it's time to exit that scale of the business. But I think I'd like to conclude on a question from Peter Fanning. Do you have any advice for SMEs where the CFO, CRO, COO, CTO could be in the same function and possibly the same person?
Well, this goes back to the question you threw at Peter earlier about the size of the organization for 3 lines of defense. And this is really difficult. So if you're, if you're a fintech, if you're an SME, you're growing rapidly, the CEO wears half a dozen different hats, and it's not possible to have segregated second and third lines. Most organizations only look at third line when they get, into the millions of turnover. So the key is to think about 4 eyes principle and think, right, okay, well, let's at least try to implement some kind of challenge process so that we don't have unconstrained decision making by the senior team. At least let's nominate someone as devil's advocate, and that is their role in these meetings. You're devil's advocate. Don't go with the consensus, do challenge us. But then again, if you are the major shareholder in a fintech startup and you've got multiple hats on, there is an element of let you get on with it, because that's how these businesses grow. So Jeff Bezos, would he have achieved what he did if he'd had someone saying, are you really sure about that? Probably not. So there is an element of letting entrepreneurs be entrepreneurs.
Yep, here.
Okay. Well, sadly, gentlemen, we have reached the end of time, but if you could just bear with me, I'd like to give 3 quick rounds of thanks. Before I do so, I think John Spain made a particularly good comment here. Alignment suggests that they all agree in an echo chamber without understanding the problems, blind leading the blind. And you pointed out, of course, I think as well, this idea of difference of opinion. And speaking as a Ned myself, where I'm seeing these things boil up, that's exactly, I think, what we try and do, is to identify where, if there is a consensus of opinion, is that a good thing? And where there's a difference of opinion, why does it exist? And these approaches that wave back and forth, I think, are very, very useful in helping to alert us to whether the strategic objectives are going to be met and what risks will throw them offline. So thank you for all of that. But a big round of thanks to our sponsors as ever for letting us range across what is a big area, risk. Thank you, the audience, for listening. A reminder that there's a lot coming forward as ever. Please visit the website. But some fascinating insights from Ariel Guckman on Thursday into some of the changes in Switzerland's wealth management industry, which I think might be somewhat informative for those of us involved in wealth management here in the UK post-Brexit. So that could be quite fascinating. But finally, if I could, I'd like to thank Chris and Peter. And Peter, maybe one day we'll see each other despite the 200 yards that separate us. And I'd like to say thank you very much to both of you for coming and presenting what's been a very thoughtful presentation and clearly very well received. Unfortunately, I am as yet unable to open the floodgates of technology so you can see the applause, but I have brought my Korean karma clapper, and I will have to make do with that. But thank you so much for coming aboard today, and thank you for sharing all of your thoughts with the audience.
Thank you.
Thank you.
Bye, everyone.